Welcome back, everyone, to the Automotive Market Minute, in which may or may not take just over a minute. My name is Steven Georgella.
My name is Philip Trepetowski.
And I'm James Sivko.
We will be talking about tariffs and why they're here to stay and the effects. We'll have our chief economist, James Sivko, unpacking that for you. National dealership performance, incentives. Are we finally seeing some real factory support? 2025 sales outlook, car buying intentions, and the EV slide, plus a little bit of bonus. What is happening in the housing market and how is that going to affect the car buying market? We'll have that unpacked by Phil and by James. With that said, turning it over to the Brainiac, go ahead.
If you enjoyed this video, hit subscribe. It's free, and we want to make more videos that you love for people just like you. Thanks for the support.
Liberation Day came with a bang. We've been following it daily here on the Market Minute. This is the upper left graph in orange. This is billions of dollars flowing into the Treasury. We're now zooming out, and we're now looking at the graph on the lower right. And the impact here has been over a point of GDP. That may mean a narrower budget deficit going forward. And we think there's even more tariffs to come. So this May number here is going to grow into and through June.
What's important to highlight here is May was very unstable for a lot of dealers. What was happening during the month of April, which again, as we saw in the end of April that I discussed during the Automotive Market Minute in the month of May, we saw that the stock market bounced really during those first 2 weeks. Phil, end of April, first 2 weeks, 3 weeks of May. So kind of right when we recorded, correct?
Correct. We recorded early April, kind of amidst the downturn. And then from there on out, the market has really showed a lot of strength.
So it's interesting here. There's a lot of instability at the dealerships. There was a lot of mentions about subprime, tough credit, a lot of individuals coming in that were upside down in vehicles. It was very easy or very difficult to get them done, if you will. James talked about having to pull extra credit reports, being creative. And so you can see here, traffic, lead volume, appointments, new sales being dropped a little bit. Used sales taking a bounce after they cooled off during the month of April. So overall, we're going to be talking about dealers having more of a bullish mentality versus bearish. I talked to a dealer on Friday this last week about some of the pain that they're feeling because they went overly conservative. It's a lot of pain. Not only are they losing market share, but their grosses, while being decent overall, they're not getting the at-bats and service because they are not getting trade-ins, because their new vehicle volume, which was 60 units, 70 units, now it's 40 and 30 units. So used cars are suffering. And regardless if they're getting better grosses, talking about $600 on the front end and $700 on the front end, what happens if you go down to $200 on the front end, which again, I'll talk about tons of dealers at $100 to $600 on the front end, but their back end grosses $2,500 to $3,500 on the back end. So we're going to be talking more and more about this change in the machine you have to create at your dealership to take market share, get more new sales, and then especially now with some more factory support, we're getting new sales, we're getting trade-ins, we're getting more vehicles to go through recon, we're supporting service. Service is making more per RO. So there's a lot of opportunity there. It just looks different is what I'm hearing from dealers. This is the new normal here at our dealership. And if we don't operate differently, we're going to struggle to gain market share or keep market share. With that said, Phil, go ahead.
Let's go ahead and look at sales from a national perspective for both new and used. For the last couple of months, we've been talking about how tariffs have pulled forward a lot of demand. Throughout the month of May and now into the first couple days of June, we are seeing retail sales down a little bit from where they were in March and April, but they are still holding steady compared to last year's levels. Now, actually, just in the latest week, for the first time in 2025, we have seen new vehicle sales actually dip below last year, 2024 levels. If you look at the used cars on the right-hand side, you will see that it's been fairly in line with the last couple of years. Historically, once we kind of get after tax season, we do see used sales volume typically fall a bit. So this is a normal seasonal pattern. But if we take a step back and we look at year to date, new sales are still up 7% year to date compared to last year. And if we look at the used market, used sales are up 6% year to date. Now, with sales starting to fall a bit over the last couple of months, Here's what the inventory supply actually looks like. You can see, again, compared to that March, April timeframe, the new supply is still tight, but it is certainly starting to stabilize. And on the used day supply, the used market has been tighter than any of these last number of years. Well, that is starting to loosen up a bit, still tighter than any of the last 3 years. But with that, we are starting to see manufacturers get a bit more aggressive. As the sales pace has started to slow just in the most recent weeks, incentives coming off the lowest point since 2019 in April have started to finally improve in June. So that's some great news for our dealers. We look forward to seeing how incentives continue to improve as the year progresses. And who knows, maybe if we start to get a rate cut or two towards the back half of the year, we may see incentives strengthen even further.
Fantastic job there. Love the energy. It's almost as if we discussed this not only last month, but the month before. It looked as if the factories were in this holding pattern where it's like, hey, we're just going to do less. We're just going to do as little as possible. As soon as we see some sort of distillation when it comes down to the tariffs and what's happening, we're going to go ahead and we're going to bump incentives to keep the juice flowing during the summer months. And so, James, I don't know if you have any additions here, but it seems as if what we said might happen during the month of February, the month of March and April, really more March and April than anything. And Travis George said this. He said incentives are going to have to come, especially for manufacturers that are struggling more. It seems that it's quite clear that the manufacturers allowed the dust to settle. They kind of peeked their head up and were like, okay, now that they have some sort of stability, they're saying, we're going to go ahead. We're going to support our dealers. We want to see our new units move. We don't want market day supply to be too high. We want to make it look good for shareholders. James, am I on the right track here?
When it turns up, it's real. We had a great first 5 months as demand was pulled forward. Consumers trying to get out in front of the tariffs. Cox has come out with a projection for 16 million units for the year. Overall, that'd be a pretty good year in the car business, right around the 80th percentile of sales volumes that we've seen over the last couple of decades. So a good year for cars. But if you do the math and you take the first 5 months and you put that in and you compare it to the 16, it does look like a little bit of a second half softening. You kind of do the algebra and you come up with 15.6 million units. So 16 million units is what we are all aiming for. And that should be an okay second half, not quite as strong as the first half.
What I want our dealers to take away with this information is, in the event and with the expectation that sales are going to contract a bit compared to these first 5 months of the year, focus on the models that are moving and moving extremely well. The month of May, we saw manufacturers kind of a bit all over the place. For example, Hyundai was up 8% year over year, and sales were up about 4% compared to April. In that, the Elantra was up 141%. The Venue was up 74%. The Tucson was up 15%, and the Palisade was up 10%, all setting May records. If we look at Subaru, the Crosstrek hit a record high at just under 16,000 units sold, up 14% year over year. The Forester followed closely behind, posting almost 15.5 thousand units. Working against Subaru was softer Outback volume and slower sedan sales. So no matter what kind of brand you have, there are certain models that are moving and moving extremely well, and there are certain models that are sitting. Make sure that as a store, you and your inventory is aligned with what the market wants, so you don't end up sitting there later on in 2025, sitting on a bunch of inventory that nobody wants. Let's go over the intentions.
This has been a great leading indicator in the past of what the next couple of months of car buying will look like, just because of the brilliant way the survey is put together. They ask consumers, are you going to buy a car in the next 6 months? And the consumers basically respond, well, is it a good time or a bad time for that? Or will I or won't I? And so this UNISH survey goes all the way back to 1979. It's great because it's a lifetime in the car business. It's really turned down. We are seeing this in other economic series where the consumer is answering surveys and saying, we're not doing anything, especially the last couple of months, but then end up going out and buying anyway. So hopefully the consumer surveys will maybe catch up to what consumers are actually doing. Isn't an indicator of a much weaker second half. So we really expect this survey data to bounce. As an aside, and a great segue here, we have a story in the housing market that we've been following now for a couple of years, and that is consumers are simply not interested in buying a house. And Stephen, that has implications for the car business, doesn't it?
The interesting part is when looking at it, first of all, to see these markets, especially in Florida, to see some of these markets finally having a little bit of compression in home prices, it's interesting to think about some of the things you've unpacked for me multiple times. If you ask an individual, hey, you're not going to move on a house, would you buy a car, or would you be more motivated to buy a car? Anecdotally, the answer is kind of always like no. But then to your point about their actual actions, they sit on the house for a while. They're like, job is still good. They're making good money. I look at the individuals that I have around me that, were people that are making 90 grand, 100 grand. I look at them, their 90 grand's 105, their 100's 120, and they're moving money, et cetera. And I'm not saying there aren't more expenses overall, but in general, they're looking at that top line and they're like, you know what? I'm going to consider a car. All of a sudden, I see them with a new car in the driveway. Feels like it's going to be a pretty good rest of the year for car buying.
If you're not going to buy a house, you're going to put a new set of wheels in the garage. We're starting to see inventories pile up in housing markets as well. In some markets, you're seeing 50 and 60% inventory growth. In other markets, low double digits. So this is an ongoing story that we think is supportive of car buying in general.
2 houses on my street, brand new construction. One of them listed at 1.3. This currently went to 1.26, currently 1.19, has not sold yet. Brand new spec home. It's been on the market now for 90 some days, something like that, 100 days at this point. I'm just saying.
We have probably a 4th month in a row of the press highlighting the fact that overall auto loan delinquencies are very high. This is really in the subprime market. If you look at the scale here, subprime auto loan delinquencies, these are 60-day delinquencies on the right scale. About 5% of those are bad. But if you go over to the scale on the left, a vast majority of loans are prime or near prime loans. That's the blue line and the left scale. And we're only talking about 40 basis points of delinquencies. So while, yes, we have overall delinquencies above those of the 2008 financial crisis, the market is still functioning for car loans, and we don't really have credit tightness other than F&I guy having to fill out an extra app here or there to get a deal done.
Guys, I'm questioning the ad system. And I'd like to be clear from an accountability standpoint. This is not to say that we don't go and check at our targeting and the choice of words and the ad copy and the creative, et cetera, et cetera. I'm not saying that that's not happening, because it is happening. So if anybody wanted to throw this back in my face, I'd like to be clear. We question, the mirror effect. We question ourselves first before we're going and look at anybody else. But you're hearing it over and over and over, James. We had 7 appointments yesterday. 6 of them we had no shot at getting done. The 7th we couldn't get done anyways. I'm not saying that we're not trying to change the targeting. It's on a regular basis and try to figure out what's going on. But James, am I crazy to say that the market of people that we're trying to go after for our dealers that are in, let's just say that are at least 30% subprime, that market is drastically different than it was even just 6 months ago, but realistically 12 months ago, it's drastically different. And that dealer should realize that his market is shrinking and he's going to have to act differently to be able to close. Am I correct in saying the fact that they should look at this very seriously as a takeaway going, we have to triple down on having cheaper inventory and working with our lenders to be as creative as possible? Yes or no?
Yeah, overall price, monthly payment, and other financial considerations are a constraint when you're dealing with that bottom third of the market. Absolutely.
The average used rate on an auto loan was 14.17% in May. rates are still extremely high. And that is why it is crucial to make sure that as a store, you have vehicles that your audience and your customers can afford.
Look at the fact that dealers, you sold this person a vehicle 2 years ago. Yes, interest rates were still, they were lower than they are now, but that individual 2 years ago had a 12% interest rate. They maybe aren't making a lot more money than they were then. They were going backwards more and more. They should have stayed in their vehicle from 2020 with a better interest rate, but they got into that one because they wanted a new one. They're going backwards and backwards. They're underwater on that vehicle. And now you have to get them at 19% versus 10%. That shouldn't be shocking by any means that you can't get that person done. They have negative equity in the vehicle, and now you have to also put them at a higher interest rate. And they didn't save more money to have a bigger down payment.
GM, Volvo, Ford, Toyota, all cutting their investments in EVs. GM, just as an example, instead, putting $800+ million into their Buffalo, New York facility to build giant V8 engines. So it looks like EV deals and EV focus from major automakers is plunging, and maybe they're just leaving it to the little specialist companies. And finally here, this is just, hey guys, keep your distance. I mean, look at all the electric cars here. This is accidents per 1,000 units. And you can see almost all of these are electric vehicles. So maybe they're getting driven more. Maybe they're getting driven for deliveries, for Ubers. Watch out. If you're going to get hit by a car these days, chances are it's an electric one.
I have one thing that I want to touch on regarding this EV situation. Had a conversation with a large Mercedes-Benz dealer here recently, and per my source, had a $129,000 EV purchase. They had an individual come in to trade that vehicle in, I believe, 2.5 years later. And I believe they were offered between 51 and 53% of the original value of that EV. And my question is, and again, this is a little bit to Phil, a little bit to James, but my question is, were we just absolutely setting up the consumer for failure? Was this just setting the consumer up for unrealistic expectations? We're giving them an $80,000 vehicle, saying, here's your $7,000 tax credit. I think it was $7,000. And it's like, so great, your $80,000 vehicle is $73,000. But then it's like, oh, and they're cheaper to maintain, et cetera. But it's like, right, but this technologically advanced piece of equipment, all those, they depreciate very, very quickly, and it hits our consumer really hard. And now you have an individual that 3 years later, let's just use an example, bought an $80,000 vehicle, got it for $73,000 after the tax credit, and they're getting an offer for $43,000 on that unit, and they get to eat that. And then I also know that dealers are apprehensive in taking in EVs as trade because they're worried about the fact that if something goes wrong, a battery, something that's very expensive, and that costs them $10,000, $20,000, $30,000 to fix.
There's a lot that's unpredictable in the EV market. Everything from repair times to repair costs, the distortion, the front end purchase distortion that incentives and tax credits are creating. And who knows what one of these vehicles is worth when it's 4, 5, or 6 years old.
A tremendous amount here that we unpacked in the Automotive Market Minute during the month of June. We've finally seen the dust settle on a lot of this tariff conversation that are going on. What's most exciting is during the month of June, we're off to a fairly solid start. We'll be getting some updates here in the coming weeks about the first third of the month of June. We're going to see a lot of action going into the month of July. And as I've said previously, the best time to set the next meeting is during the current meeting. And so we'll see you guys next month on the Automotive Market Minute. On behalf of myself, my esteemed colleagues, Phil Chebotowski and James Sivko, see you next month. Out.